All right, so what if, like, going to space wasn't only for astronauts, What if more people could experience it?
Yeah, that's exactly what Virgin Galactic is aiming for, right? They want to make spaceflight way more accessible, not just for like super rich tourists, but also for researchers. And they want to change, like how much it costs to get to space, really make a difference there.
And that's what we're diving into today. Virgin Galactic Holdings, SPCE.
hmm
We're looking at them through the lens of, Warren Buffett and his value investing principles.
Yeah, we dug through a ton of information reports, expert opinions, news articles, all that, trying to give you the key insights and help you understand if Virgin Galactic is like a smart
It's got a
investor.
roadmap for you to figure out,
Mm,
like, the core potential of this company.
yeah.
So if you're into this kind of deep dive, make sure to hit that subscribe button. We've got more coming.
All right, let's get into it. First, we got to understand the business, right? Virgin Galactic, they want to make space travel more accessible, but they're also all about developing their own unique tech and procedures.
And their home base, Spaceport America in New Mexico, it's the world's first purpose-built commercial spaceport. The climate there and the controlled airspace, they say it's a huge advantage because it minimizes, delays from weather and stuff.
Right, being the first in this market has its perks, but it also comes with some unique risks. Like, if something happens at Spaceport America, it could halt their entire flight program.
So how do they make money? Well, the big one is those suborbital spaceflight tickets,
Hmm.
and they're really targeting those high net worth individuals.
And the prices are, well, let's just say they're not cheap. Started around $200,000, then went to $450,000, and now future seats are like $600,000 each.
Wow.
But here's the thing, they already have around 700 people from over 60 countries who've put down deposits. So there's definitely a demand.
Besides the tourism, they're also looking at diversifying into research and payload delivery,
Mm.
using their flights to provide that microgravity environment for scientific experiments.
Yeah, that research revenue could be more stable than tourism, which can be kind of unpredictable. Plus, they have the Future Astronaut Membership Program, which brings in some upfront cash. And they're exploring other options too, merchandise, events, even government and commercial contracts.
Makes sense. Now, the costs. It sounds like the upfront investment to design, build, and test these spacecraft is, well, astronomical. And then the ongoing research and development, especially for the next-gen Delta class, adds to that.
Oh, for sure. Aerospace is a seriously capital-intensive industry. From design and materials to rigorous testing, it all costs a fortune. And then there are the operational costs, the flights, the maintenance to keep everything safe and running smoothly. They're betting on regular, repeatable flights to lower the per-flight costs over time.
And a key part of that is scaling up their fleet. More spaceships means spreading those fixed costs over more flights, ideally leading to better profitability. They're projecting about $100 million in adjusted EBITDA once they have 2 new spaceships and a mothership running consistently.
High upfront costs, ongoing R&D, their profitability hinges on scaling up successfully and diversifying their revenue. If they can pull it off, and that's a big if, it could be a solid long-term play.
So what about the experience itself? Their space tourism package sounds incredible. A 5-day readiness program, custom spacesuits, even astronaut wings afterward. It's a whole experience they're selling.
Right. It's not just a flight. It's like joining this exclusive club. They have the future astronaut community, VIP events, partnerships with luxury brands like Land Rover. It's a whole lifestyle.
And the flight itself, it's complex ascending with the mothership, the release, the rocket boost, and that feathering reentry. And of course, those few minutes of weightlessness with those amazing views of Earth.
Yeah, it's unique. It's designed to be both thrilling and accessible, even for people who haven't had astronaut training. And their focus is on making it safe and luxurious.
And on the research side, it's not just about the spectacle. They're offering a platform for microgravity experiments.
Right. They're partnering with Redwire to put payload lockers on their Delta-class spacecraft, which is going to be a huge boost for research. These spaceships will be like suborbital labs for all sorts of experiments, testing, and even astronaut training.
I see.
And they're offering researchers a lot of flexibility. Dedicated training, research labs at Spaceport America, and immediate access to their payloads after the flight. They can fit multiple payload racks and even have researcher astronauts on board. So the research possibilities are pretty wide-ranging, from plant studies to testing medical devices and observing fluids in low gravity.
So this focus on both high-revenue tourism and more steady research funding makes their business model more resilient. It's a smart move.
It's smart diversification. They're not putting all their eggs in one basket. Having both the high-end tourism market and the scientific community as customers, it makes them less reliant on a single, potentially volatile market. And it gives them more credibility and expertise in the tech. It's a positive sign for long-term stability.
So who's their target audience? It seems like it's primarily affluent individuals, high net worth and ultra high net worth, those who can afford the price tag and have a passion for space and adventure. They estimate a market of around 200,900 individuals at that $450,000 price point, plus, of course, the research clients from corporations and government.
Yeah, they're very specific about their customer. It's not for the masses, it's for the select few. They're all about personalized service, dedicated account managers, and building a community through that future astronaut program.
They have those exclusive events, partnerships with luxury brands. They're leveraging the buzz around space with publicity and social media, and using a two-pronged sales approach their own team and those accredited space agents.
They're also counting on referrals from the Virgin Group, Richard Branson himself, and happy customers spreading the word. It's all about building that premium aspirational brand. But for a value investor, that super niche focus raises some questions about long-term scalability compared to, say, a broader market strategy.
Right. So their competition. Blue Origin seems to be their main rival in suborbital space tourism. But then there's SpaceX, which might enter the space tourism market more seriously in the future.
Exactly. Virgin Galactic's advantages seem to be their pioneering role, the unique experience, their technology, the reusability of their spacecraft, and their air launch system. They're really playing up the luxury and safety aspects, especially for those who aren't professional astronauts.
Blue Origin, on the other hand, has a more long-term vision. Reusable rockets, space colonization, manufacturing, and plans for orbital and even lunar missions.
Right. And SpaceX, led by Elon Musk, they're all about orbital and interplanetary travel, with that super reusable Starship tech that could really drive down the cost of space travel, including tourism. That could be a big game changer.
It sounds like Virgin Galactic has a unique edge in this luxurious suborbital market. But the question is, how will SpaceX's push for cheaper space travel affect Virgin Galactic's pricing and market share in the long run? That's something a value investor would be watching closely.
Absolutely. All right, let's move on to the people running the show, the management team. The CEO, Michael Coglazier, has a very interesting background. Over 30 years at Disney, including leading Disney Parks International and Disneyland Resort.
So he knows a thing or two about strategic planning, customer experience, managing large teams, and launching new products, especially in a consumer-focused environment.
That experience is really relevant to the space tourism side of things, creating that unforgettable world-class customer experience. His priorities at Virgin Galactic are safety, scaling efficiently, top-notch engineering and manufacturing, and of course, customer satisfaction.
I see.
Right. He's also on advisory boards for UC Irvine and Rice. That Disney background could be a real asset for shaping that high-end, experience-driven aspect of what Virgin Galactic offers. Now, the CFO, Doug Ahrens, he comes from the world of finance with over 25 years in multinational corporations, particularly in complex tech and manufacturing.
His experience with scaling global manufacturing operations is key for Virgin Galactic's growth plans. Plus, he's got expertise in capital markets and mergers and acquisitions. He was the CFO of Mellanox Technologies when they were acquired by NVIDIA, which is a huge deal. And he's held CFO roles at other tech firms like Global Logic and Applied Microcircuits.
Yeah, and before that, he had finance positions at Maxim, Intel, and Chevron. He even has a private pilot license.
Wow.
His background is a perfect fit for Virgin Galactic's capital-intensive nature and growth goals. His experience in scaling tech and manufacturing companies, along with his capital markets knowledge, are crucial as they move towards larger-scale operations. So the takeaway here is that the leadership team has the right mix of experience. The CEO's expertise in consumer-focused businesses, particularly his time at Disney, is perfect for space tourism. And the CFO's background in scaling tech and manufacturing, along with his finance skills, are really valuable for Virgin Galactic's growth phase.
Now, about the board of directors, the group overseeing everything. They seem to have a diverse set of skills: aerospace, manufacturing, safety, risk management, supply chain, consumer experience, finance, and even government.
It's a well-rounded board. Raymond Mabuse is the chair. He was the U.S. Secretary of the Navy, ambassador to Saudi Arabia, and governor of Mississippi. So he brings experience in government, international relations, and consulting.
Right, right.
And then you have Hinio Arcangeli Jr., who was a senior VP at Honda and Acura and had senior roles at Yanmar and Yamaha. He's got that automotive and industrial products background.
Makes sense.
And there's Luigi Brambilla from the Virgin Group with a strong background in investment and capital markets and 10 years with the Virgin Group already. The other board members also have experience at the executive level in different industries, some with specific expertise in aerospace. Having those strong financial and investment backgrounds is key for guiding the company's financial strategy and growth plans. So the board seems well equipped to provide effective oversight and strategic direction.
Right, let's talk about executive compensation, a sometimes tricky subject. In 2023, CEO Michael Colglazier's total compensation was over $7.7 million, with a $1 million base salary plus bonuses and stock awards. That seems, pretty substantial for a company that hasn't yet turned a profit.
Yeah, it is a lot, especially when you compare it to CEOs of companies with similar market caps. And his direct ownership stake in the company is just 0.17%, which is worth about $193,600.
So for a value investor, that high CEO compensation while the company's still losing money raises questions about whether management's interests are truly aligned with those of the shareholders. Stock-based compensation is meant to incentivize long-term value creation, but the overall amount at this stage might be seen as too high.
Right. Looking at their track record, a big win for them was going public through that SPAC merger back in 2019. And they did achieve those commercial space flights with VSS Unity in 2023 and 2024, which is a huge milestone.
They've also paused commercial flights, for now, to focus on developing the Delta-class spacecraft, which is supposed to start commercial service in 2026. It's a strategic move for better scalability. They've also secured partnerships, like with Redwire, for those payload lockers on Delta. And they're looking at expanding globally, starting with that feasibility study in Italy.
It's all progress, but remember, back in 2021, an independent analysis actually recommended shorting the stock. They questioned if the CEO's theme park background was the right fit for the complex world of spaceflight, and they thought the company might be underestimating the challenges of scaling up.
That's worth keeping in mind. So while management has made progress, those concerns about the CEO's relevant experience are something investors should watch as the company executes its plans.
Definitely. And we can't ignore the governance issues and controversies that have come up. Multiple shareholder class action lawsuits alleging false or misleading statements about their spacecraft development and insider stock sales by Richard Branson based on non-public information. One lawsuit even claims Branson illegally sold about $1 billion worth of stock in 2020 and 2021 based on what they call inflated hype.
That's a serious allegation.
Yeah. And then there's the lawsuit from Boeing's subsidiary, Aurora Flight Sciences, claiming Virgin Galactic stole trade secrets for a new mothership project and didn't pay about $25 million in bills.
That's a problem.
Right, big problem. They've also had delays in their development and testing programs, which makes you wonder how accurate their future projections are. And in the middle of all these lawsuits, their chief legal officer resigned in July 2024.
These legal challenges are a huge red flag for investors, especially those who care about ethical management and transparency. The shareholder lawsuits alleging fraud and insider trading are particularly concerning. And that lawsuit with Boeing raises questions about their supplier relationships and how well they protect their intellectual property.
Definitely some things to watch. Now let's dig into their financials. Their 2024 revenue was $7 million, same as in 2023. That's up from $2 million in 2022, so there's growth, but it's still super early in their commercialization phase.
Yeah. Most of their revenue comes from those initial commercial flights and fees from the Future Astronaut program. But in the fourth quarter of 2024, the revenue actually dropped to $0.4 million compared to $2.8 million in the same period of 2023, mostly because they stopped flights to work on the Delta-class development.
Right, that makes sense. But their future revenue projections are, well, pretty bold. They're expecting major growth with the Delta-class launched in 2026. Initially, they're projecting $450 million in annual revenue based on 750 customers a year at $600,000 per ticket. And they think it could reach almost $1 billion with more spaceships, and even $2 billion if they add more spaceports. The Delta class is supposed to be much more profitable, with an estimated $3.6 million in revenue per flight.
That sounds promising.
It does. But it's important to note that they're still in the very early stages of generating revenue. Those projections depend heavily on the Delta class being successful, which is far from guaranteed. It's a high-risk, high-reward situation.
Right. What about profitability? They're currently operating at a loss. Their net loss for 2024 was $347 million, which is better than the $502 million loss in 2023. Their adjusted EBITDA was negative $289 million in 2024, also an improvement from negative $427 million in 2023.
It's getting better.
Yeah, but they're projecting that once their initial fleet is running smoothly, they could achieve adjusted EBITDA margins of 20 to 25%, with the potential to hit about $500 million in adjusted EBITDA with 4 spaceships. And the Delta class is projected to have contribution margins of over 80%, with the aim of reaching positive EBITDA.
So they're losing money now, which isn't unusual for a company at this stage, but their future profitability depends on hitting those high margins with Delta and scaling up effectively. That's a big if.
Looking at their balance sheet, at the end of 2024, they had $657 million in cash equivalents, and marketable securities. That's down from $982 million at the end of 2023.
It's a decent cash cushion, but it's shrinking. It shows they're spending a lot, which needs to be addressed if they want to be profitable.
Their free cash flow for 2024 was negative $475 million, slightly better than negative $493 million in 2023. They're also expecting negative free cash flow in the first quarter of 2025. They used $353 million in cash for operating activities in 2024, and their capital expenditures jumped to $122 million, mainly because of the Delta program. They did raise some money, $138 million through equity financing in 2024, and $484 million in 2023 through at-the-market offerings.
So big negative free cash flow and operating cash flow, it's clear they're spending way more than they're bringing in. That increase in capital expenditure is expected with Delta, but relying on equity financing can dilute the value for existing shareholders.
What about debt? They did that convertible debt offering in January 2022 for $425 million. And back in 2020, their debt-to-equity ratio was over 150%. We'd need more up-to-date financials to see where their leverage stands now.
That 2020 ratio was pretty high, showing a lot of leverage. We'd need more recent data to assess their current solvency and risk.
Right. So to sum up their financials, they're aiming for $450 million in annual revenue with their initial Delta fleet, and potentially $2 billion with more spaceships and new spaceports. They're projecting that each Delta spaceship could bring in $3.6 million per flight, with a target of 8 flights per month per spaceship. They think they could make between $1.1 and $1.4 billion annually from just one fully operational spaceport if they capture less than 1% of the potential market. But they'll need more money to make those fleet and spaceport expansions happen.
Their financial future depends on Delta being a smashing success. They need to attract enough customers who are willing to pay those premium prices. And they'll likely need more funding, which could mean more shares and more dilution for existing shareholders. It's a lot of ifs.
That was a lot to cover. We've gone through Virgin Galactic's business, their management, and their financials, all through the lens of value investing. There's huge potential, but also a lot of financial and operational hurdles, and the losses continue. Coming up, we'll look at market sentiment, ownership, and do a SWOT analysis to see the risks and opportunities more clearly.
And just so you know, all the sources we use for this deep dive are linked in the description below.
Yeah, check them out. And let us know in the comments what companies you'd like us to cover in future deep dives. We'll be back after a short break.
See you in a bit.
Welcome back. Let's get into Chapter 4, Market Sentiment around Virgin Galactic. In early 2025, the stock is trading around $3.02. It's been pretty volatile, especially in 2024, and looks like that downward trend might continue. As of June 2024, their market cap was about $350 million. It's crazy to think that the stock is down over 90% from its peak in February 2021.
That's a big drop. It shows a lot of skepticism from investors and negative sentiment in the market. The main concerns are those ongoing losses, program delays, and a lack of clarity about when they'll actually become profitable. And the high volatility suggests that there's more than just fundamentals at play, maybe some speculative trading going on.
If we look at what the analysts are saying, it's a mixed bag. None of the 12 analysts covering the company are giving it a strong buy recommendation as of early 2025. Price targets for 2025 are mostly in the low $2 range.
Yeah, around $2.88 to $2.90.
But there are some outliers. Jefferies has a buy rating with a $10 target, while Goldman Sachs has a $36 target. Morgan Stanley, though, has an underweight rating and a $5 target, down from $35.
Quite a range.
Yeah. The general feeling is that there's potential for a double-digit gain from the current price, but no one's really sure.
No one's quite sure. The market's still trying to figure out if Virgin Galactic can overcome the risks and reach its potential. Now, let's look at ownership. Richard Branson, the founder, sold a ton of his stock, about $1 billion worth, between 2020 and 2021. And the former chairman, Chamath Palihapitiya, also sold a big chunk of his shares, 6.2 million shares, for around $213 million in March 2021. The current CEO, Michael Glazer, has a pretty small stake, just 0.17%.
So when big insiders like the founder and the former chairman sell that much stock, it can make investors nervous. It could mean they're not confident in the company's future, or maybe they were just taking advantage of a high stock price. And the CEO's low ownership stake might raise some eyebrows, making people wonder if his interests are really aligned with those of the shareholders.
Yeah, it's something to consider. The stock also has a high short interest, meaning a lot of people are betting on the price going down. Plus, it was caught up in that whole meme stock frenzy, remember the GameStop saga? So it can be influenced by social media and speculation, leading to big price swings that aren't really tied to the company's actual performance.
Right. And when we look at news and social media, it's all over the place. You see articles about their innovation and potential, but also a lot about their losses, delays, and legal troubles.
Yeah.
The stock price can jump or drop based on a single tweet or trending topic.
It's very reactive to news and social media, and that can create both opportunities and risks for investors because those short-term price swings might not reflect the company's real value.
Chapter 5, Ownership Structure. We covered that when we talked about institutional and insider ownership. Let's move on to Chapter 6, Risk Assessment with a SWOT Analysis.
All right. Starting with technological and operational risks. Their rocket motor technology is complex, and space travel, by its nature, is risky. They've had test flight failures and incidents in the past, which highlights those dangers. And because their system uses two separate airframes, the mothership and the spaceship, it adds another layer of complexity and potential points of failure.
Right.
They're also really banking on the Delta class being developed and launched on time and successfully. Any delays could be a major setback. Plus, their system has a lot of moving parts. If any one of those critical components fails, it could have a domino effect.
It's a high-stakes game.
For sure. Now, looking at competition and market adoption risks, there's more competition in space tourism, especially from Blue Origin, and SpaceX might become a bigger player down the line.
And there are questions about how big and sustainable that high-priced space tourism market really is.
Exactly. And what if someone comes along and offers a different, maybe cheaper space experience, like orbital flights? That could also be a threat to Virgin Galactic's position. Moving on to regulatory and legal risks. Commercial spaceflight regulations are still evolving, and the FAA is keeping a close eye on everything. If there's an accident, the legal fallout could be massive. And don't forget about those shareholder lawsuits alleging fraud and misleading statements. Those could lead to big fines, legal fees, and damage to their reputation. And the lawsuit from Boeing's subsidiary adds to the uncertainty, raising concerns about their relationships with suppliers and their ability to protect their intellectual property.
All serious issues.
Definitely. Now, financially, their history of big losses and burning through cash is a big concern. They need tons of money for the Delta program and future infrastructure, so they'll probably have to raise more capital, which could mean more shares and dilution for current shareholders.
Right.
And there's no guarantee they'll become profitable when they expect to. Any delays can make their financial situation even worse. Reputationally, they're really vulnerable to bad press. Any more test flight failures, operational hiccups, or negative outcomes from those lawsuits could really hurt them. Their image took a hit from that whole meme stock thing, too, which might not sit well with serious institutional investors. And anything controversial involving Richard Branson, like those insider selling allegations, could tarnish the brand and erode trust.
It's a mixed bag. A SWOT analysis shows that Virgin Galactic has a lot of potential, but faces some serious challenges.
It's a classic high-risk, high-reward scenario. Now, let's wrap up with our conclusion, Chapter 7.
Okay, so after this deep dive, what can we say about Virgin Galactic from a value investing perspective?
Well, it's an intriguing opportunity, but definitely a risky one. They've got the potential to be a leader in a brand new market, they've got unique technology, and their management team has a lot of experience.
Right. But There are also those big concerns. We talked about limited revenue so far, significant losses, relying heavily on the Delta class being successful, uncertainty about future demand and competition, and of course all those legal and governance issues.
Exactly. Remember Warren Buffett? He likes businesses that are easy to understand, have a proven track record of making money, are financially solid, have ethical and competent leaders, and are priced fairly. Right now, Virgin Galactic doesn't tick all those boxes.
So here's something to think about. What would have to happen for Virgin Galactic to become a solid investment for a value investor? Would it take a huge tech breakthrough, maybe space tourism suddenly becoming super popular, or perhaps a shift in their strategy to focus more on that steady research revenue?
Those are the big questions. Virgin Galactic's future is exciting, but also very complex and uncertain.
Well said. And that's it for our deep dive into Virgin Galactic. If you enjoyed this analysis, please subscribe to the Stock Analytics AI YouTube channel for more in-depth looks at different companies and investment strategies.
And one last reminder, this deep dive is for information only. It's not financial advice. We use AI to analyze information, but you always need to do your own research before investing in anything. Remember, all investments come with risk, and what happened in the past doesn't guarantee what will happen in the future.
Thanks for joining us, and we'll see you in the next deep dive.
See ya!
Bye.
Bye.